Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Wednesday, October 14th, 2020, and I am pre-recording this Trading Places Live for Thursday, October 15th. Futures are weak after hours with the Dow and S&P down around 0.25%, the NASDAQ down a little bit more at about 0.5%, continuing a little bit of the weakness that we saw on Wednesday. Before we get into all of that, though, let's go ahead and run through the agenda. Going to get into that daily market recap, take a look at what happened on Wednesday. In the news, there are a few companies that I want to talk about that reported some interesting data after the bell. 3 positive, 1 negative. We'll take a look at those charts. Talking technically, I'm going to get into a couple ratio charts that I like to follow and kind of give you a reason why I think we're going higher in the fourth quarter. Then in the chart lists, this is a relatively new segment that I started recently, just looking at some of the best and worst performers in the chart lists that we keep at StockCharts.com. It's really our research platform where we keep a lot of our information and organize it into chart lists. So we'll go through that. Earnings spotlight, got a number of companies reporting after the bell on Wednesday, a few more reporting on Thursday morning, and then we'll wrap it up with 3 you must see, 3 charts I think you'll be interested to take a look at with me. That's how we'll wrap up the show. But before we get into any of that, I do want to take you over to earningsbeats.com. You can see here right on our screen that you can subscribe to our free Earnings Beats Digest newsletter, simply typing in your name and email address. Hit that subscribe button. We'll get you set up. We publish our newsletter Mondays, Wednesdays, and Fridays. It is completely free of charge. There is no credit card required, and you can unsubscribe at any time. It is an educational newsletter. Do try to provide some really good information as to companies either that have beaten earnings expectations, revenue and earnings expectations. They may be pulling back, presenting a nice trading opportunity. I do a lot of work with relative strength. So many of the EB Digest articles have to do with relative strength. I think you'll find it very educational. The other thing you can check out while you're at Earnings Beats is our portfolios. These are provided to our members in real time, 4 times a year. Each one of the portfolios has 10 different companies from 10 different industry groups. They're equal weighted, and the stocks are changed every 90 days. We're essentially looking for leading stocks in leading industry groups over a 90-day period. And then after earnings season, we go through, we do our reevaluation all over again and come up with 10 new equal weighted stocks, new leaders in leading industry groups, and hold those for another 90 days. So it's just a rinse and repeat. We've had tremendous success, and you can see those numbers right there on your screen. We'd love to have you try us. You can take out a 30-day, essentially no-cost trial by clicking on this Join Today button. You will be charged $7, but we'll refund it to you. We'd love to have you join us. We do have a couple of big events coming up next week, and they're both members-only events. We are going to unveil our very first model ETF portfolio. So all of our portfolios, the 4 that I showed you down here, these are all stock-based, so individual stocks. Monday, we're going to announce our very first model ETF portfolio. I think that's very exciting. And then we will get into quarter 3 earnings, and I'm going to point out to our members some of the upcoming earnings reports that you really want to keep an eye on. I think there will be some very bullish reports that come out, some bearish reports, and you're going to want to know the difference. So if you do try us, take out that 30-day trial. The webinars will all be part of that. So we'd love to have you. All right, let's talk a little bit about what happened on Wednesday. Market pulled back, nothing horrible. Everything was down less than 1%. Roughly 0.5 to 1%, or half to maybe 4/5 of 1%. Dow Jones Industrial Average down 165 points. The S&P down 23. NASDAQ down 95. NASDAQ's loss of 4/5 or 0.8 of 1% was the highest among the major indices that I'm showing here. Mid caps down a little less than 0.5%. Small caps down a little more than 0.5%. Leading sectors: industrials up more than 0.5%. Energy up 0.43%. The laggard on the day, communication services, down more than 1% on the session. As far as the industry groups go, marine transportation was the strongest group. You can see this has been in a horrible downtrend, though, getting a little bit of a bounce. I certainly am not a fan of this group, but it did lead on Wednesday. Lagging on Wednesday, banks. Two things really driving the banks lower. The 10-year Treasury yield has not been able to sustain its move to the upside. That is hurting banks. But then also earnings reports coming out this week. And honestly, they're not great. And the ones that are, that do look pretty good, the stocks are still selling off. We saw a couple of decent reports. I mean, JP Morgan wasn't bad. Citigroup beat on their bottom line. Both those stocks gapped up after earnings, but then have been selling off since. It's just not been a very good environment for banks, and I would continue to stay away from the group. All right, 10-year Treasury yield. Talked about this a little bit. We did hold on to the 20-day moving average on this pullback. So if there's one, maybe if you want to call it silver lining, I would say it's that even though we did sell off here over the past few days, the bond market was closed. Treasury market was closed back on Monday in observance for Columbus Day. But we did come back these last 2 days, pulling back quite a bit. Last Friday, we had hit 0.8%. Today's low, just a little above 0.7%. So it's been a pretty steep drop in the yield, but we did hold right on that 20-day moving average. We're going to want to watch that on Thursday and in the days ahead to see if we can continue to trend higher. As far as economic reports out on Thursday, initial jobless claims expected to come in at 825,000. Last week it was 840,000. So we're looking at about a 15,000 claim drop. That's what's expected. We'll see what happens at 8:30 in the morning. October Philadelphia Fed Manufacturing Index expectation 14.5. That's a slight drop from September, which was 15. And then the October Empire State Manufacturing Index also expecting 14.5. September number there was 17. So both of those numbers expected to drop a little bit. All right, let's move on to in the news. I do want to point out a few companies came out after the bell. The one that came in with the biggest shocker to the downside, Fastly, FSLY. This is one of our portfolio stocks, actually, so it's not going to be a strong start for, I think this one's in our strong AD portfolio, but that portfolio has been on fire. And part of the reason it's been on fire is that Fastly has been going up, but it is giving up a lot of those gains in after hours on Wednesday. The stock was down 26.5% in after hours after they guided their Q3 revenues lower and effectively just said, you can't count on our full-year guidance that we provided earlier. So the market doesn't like uncertainty. This is going to be a really interesting stock to watch on Thursday because I had actually been looking and there was a ton of in-the-money calls as a result of this huge move up here in October. So a lot of option traders buying calls in this stock, and many of them wiped out as a result of this news after the bell. And now with the stock trading closer to $90 after the bell, it's actually underwater in terms of options. Now they're more in the money puts. So I think after it gaps down in the morning, maybe we see a little bit of selling, but I think you're going to see buyers coming back into the stock. I don't know if we close back above the 20-day moving average, which is 106, but that would be bullish if it did. If it gapped below and could come back up and close above that 20-day moving average, that would be a very, very bullish reversal on Thursday, something to watch for. Next up, with some guidance after the bell, Cars.com guided their Q3 revenues higher. The stock up nearly 5% after hours. I think it's still got a lot of work to do here. I'm going to pull up the relative charts. You can take a look here. But Cars relative to the software stocks, down near the low relative to the S&P 500, really has struggled over the course of the last several months. I'm just not a big fan we did get that good news after the bell, so we will see some early morning strength. I just don't know if it continues. Now, if we could break out above $10, start showing some relative strength, then that would be a different story. But for now, I'd be a little cautious. Vishay, VSH, guided their Q3 revenues higher, stock up 3.5% after hours. And this one is going to be a little more interesting because it's going to be up closer to that 18 level. And you can see 18 has been key resistance on this stock now for the past 3 to 4 months. The AD line, very weak. So it does look like there's been distribution. We're getting a gap up. This could be another opportunity for folks to sell into the strength. So I think it's going to depend what happens after the gap up, not necessarily what is happening with the gap up. Let's see if we get that breakout. The last one was ORGO. This is Organogenesis. Stock's been going sideways. Not really much action in terms of volume. So this is a stock personally that I would not be interested in because of the fairly light volume. But the stock was up 28% after hours. So I thought it was worth mentioning. When you look down at the relative strength, it's in the medical supply area. This has been a very weak stock within that area, and it's also been very weak versus the S&P 500. So yes, it's going to see a nice move to the upside at the open. Does it hold? And I don't know. Ordinarily the volume's just too light. I am going to pass. Moving on, talking technically. So I wanted to talk a little bit about the consumer discretionary versus consumer staples. And actually, before I even get into this, I want you to look at the S&P 500. When we look at this over the past 3 years, I know, we can look and say, well, we had this huge move back in the beginning of 2018. Then we had the big drop. Then we had another really nice rally. Then we had the fourth quarter trade war issues of 2018. Then we had this huge rally back up into May, and then the trade war came back up again. We struggled. Then another big rally into early part of 2020. Then we had the pandemic, and then started to rally back up. But my point here is, when you look over the past 2 years, there was lots of ups, lots of downs, but really we didn't go anywhere. It was sideways consolidation. Part of the reason is that in order to get a sustainable, this is based on history, in order to see a sustainable market advance, you need a couple of things. One, it's really nice to have the XLY trending higher versus the XLP. This is an analysis of consumer stocks. And anytime you have discretionary stocks outperforming the staple stocks, normally that leads to a very good market. We had that throughout 2017 into 2018. But then you can see we had this downtrend in play for quite a while. And I'm just going to bring this. I just want to show you this trend line here. So right about there. But I think it's pretty clear that we had a downtrend in play, XLY versus XLP, throughout most of 2018, all of 2019, and through the first 4 months of 2020. But when the market rallied back, look at what happened here. We broke this downtrend, and then we went and set new all-time highs on the XLY, XLP. I believe this is a signal that this rally that we've been seeing this year is very sustainable. I'm looking for the market to continue moving higher, and this is one of the reasons why. Now, we have come up a lot. I wouldn't be surprised to see a little pullback, but I believe this uptrend is here to stay with us for a while. And as a result, I believe we go higher. The other relationship I wanted to point out is transports versus utilities. Utilities are defensive. Transports tend to do much better when the economy is strengthening. Now, if you look at this chart, and I'm going to connect these highs. And then for the most part, we were in this channel. We went a little bit below here. But all but this, panicked low in March. For the most part, we were just in this down channel on, looking at transports relative to utilities. Once again, the entire time the S&P 500 was going nowhere, this was trending lower. But look, in the summer, we actually broke out in this ratio. And now, just recently, we've seen transports break out to an all-time high on an absolute basis. I believe this is yet another signal that the stock market's going higher. We can, look at some consolidation, maybe see a little bit of back and forth in the short term. But I really believe between now and say the beginning of 2021, we're going to see higher prices. I'll be surprised if we don't. And these are two charts certainly worth keeping an eye on that I think support higher prices. All right, now I looked at consumer stocks a minute ago, and I showed the strength in consumer discretionary. And I actually am a big fan of consumer discretionary stocks. So I thought what I'd do is show you my relative chart on these consumer discretionary stocks versus the S&P 500 going back 3 years. These are weekly relative charts by various industry group within consumer discretionary. And I just want you to be aware of the groups that are leading this charge in consumer discretionary to the upside. I'm really going to focus on relative PPOs, relative weekly PPOs that are above zero, where relative price action is above the 20-day, which is above the 50-day. This is not a good setup here. This is the opposite of what I'm looking for. So hotels, no, I'm not interested. How about toys? Toys are strengthening. Relative PPO positive territory, price action above the 20, above the 50. Everything looks good with toys. Restaurants strengthening. This is a really important one here. I think this is a group that's going to continue to do very well. Restaurants have broken above their moving averages. The relative 20-week moving average moving through the 50. PPOs turned positive. This is an improving group. Specialized consumer services, also an improving group. Look at the move in relative price action above the 20, above the 50, relative PPO positive. Next up, clothing and accessories, strengthening. Look at the PPO turning positive. Price action above the 50, 20 is gaining on the 50. Another improving area. Home improvements already strong. PPO well above the zero line. Price action above the 20, above the 50. Recreational services, stay the heck away. I don't even need to talk about this. This was a group that really got hit hard, rebounded. This does not mean, by the way, that we're seeing a lot of strength. What it means is that we're not seeing the devastation that we saw back in February and March. I mean, look at the relative weakness. So just by bouncing a little bit in terms of relative strength, we've gotten the relative PPO to bounce. This is still incredibly weak. I'd stay away. Apparel retailers, yeah, I'm going to say about the same thing. It's not as weak, obviously, as recreational services, but we are starting to roll back over below the 20, which is below the 50 PPO in negative territory. I might stay away there. Specialty retail, I still like it. Price action above the 20, above the 50, PPO strong. Travel and tourism, not really interested. Relative downtrend now in play for about 2.5 years. And we have been staying mostly below the center line on the PPO. Just stay away. If they're not leading, stay away. Gambling stocks, stay away. PPO, negative, rolling back over, price action below the 20, which is below the 50. Home builders very strong, though. Price action above the 20, above the 50, and the PPO in positive territory. Very strong area. Broadline retail, one of the strongest areas. Now you look at this PPO coming down, relative PPO, and you think, oh, it's horrible. Well, it's not horrible. It's just that we were really strong for a while. And while we're starting to gain strength again, we're not going up as fast as we were. So it's not that the PPO is weak. It's just that the incredible strength has slowed somewhat to a point where we're just outperforming a little bit instead of outperforming a lot. Broadline retail, still a strong area. Furnishings, improving. PPO has turned positive. Price action trying to get through the 50. Still got some work down here to do, but it definitely is an improving group. Footwear, I think, has become one of the better groups. After sideways consolidating on a relative basis for about 1.5 years, we broke out about 6-7 weeks ago. Really soared. Look at that relative PPO. Price action above the 20, above the 50. Looks good. Business training and employment agencies, it's trying to do a little bit better. PPO getting closer to the center line, but we still have this downtrend. Still got some work to do here. The durable household products, I think this group is definitely one of the improving areas. Relative price action above the 20, above the 50. and that relative PPO very strong and getting stronger. Autos, there is no better area in the stock market right now than autos. Not all autos. I'm not a fan of GM and Ford, but when you start talking about these electric vehicles, NIO is up 25% or 22% today. Tesla starting to get on a roll again, breaking out again above recent highs. These are areas, or these are stocks within this area that just look to me to be very, very bullish. So I think autos look good. Recreational products, very strong. We've moved back above the 20 now, which is above the 50. The PPO remains in positive territory. I think that's a great group. Auto parts strengthening. Still got some work to do, but the relative PPO has gone above zero. First time we have seen that since probably 2.5, maybe a little more than 2.5 years ago. We are now above the 50 week moving average in terms of relative price action. 20 is trying to cross the 50. We have not seen that in almost 2.5 years as well. So there are some positives here, but we're not quite out of the woods. Anyhow, those were the areas of consumer discretionary that I think are worth watching. Got a lot of strong groups there and a lot strengthening. The ones that aren't strengthening, that continue to be underperformers, stay away. It's that simple. Stay away. All right, moving on. Chart lists. Just wanted to give you a few companies that I think look, decent based on our chart list. I mentioned NIO. This was the best performing company in our strong earnings chart list today. As I mentioned, it's also in one of our portfolios, in our strong AD portfolio. So the gains here today, 22%. I guess you can say probably going to be offset by the losses tomorrow morning by Fastly. But I mentioned recently the stock was in an uptrend. You can see this kind of flag action. It looked to me like a bull flag, which was very bullish. We got that breakout. Look at the volume. I mean, that is just crazy. 387 million shares traded hands or changed hands. And the stock finished near its high, opened down at 23.98 and closed at 26.50. So with that, you can see the AD line made another breakout. Worst performer in the strong earnings chart list goes to LQDT. This is liquidity services, but this is after a huge move to the upside. This is a stock that's been gaining strength, performing very well. Yes, it was down 8%. Another 8 or 9, 10%. We're probably going to be getting close to that 20-day moving average. I think $8.50 to $9 is going to be a great area if this stock continues to sell off. All right, let's move on to the short squeeze chart list. Best stock? Well, if you've been watching, this stock just will not quit. 26 consecutive days that Jinko Solar has printed a higher low, a higher intraday low, 26 days in a row. I don't think I've ever seen this before in my entire career. This has just been a crazy move to the upside. And the day that it went through 29 was the day earnings came out. And I remember talking about this, saying it was a heavily shorted stock, and it was in a strong group, and it has become a leader, and shorts are running for cover. Now, the interesting part, we have got a ton of in-the-money calls right now. So I don't know how much further JKS is going to run before options become an issue. But right now, until it prints a lower low on the daily chart, I think you got to stick with this move to the upside. If I'm in it, I'm holding it. The worst performer in the short squeeze is AMC. And this is why you just don't go buying any stock in the short squeeze chart list. You wait to see breakouts. And when they fail, you want to get out. I would have said AMC looked really good back here, trading above the 20-day moving average, went all the way up to test this prior high, but could not break out. And now it is down below the 20, which is below the 50. And AMC looks very, very weak. Strong future earnings chart list. How about Bed Bath & Beyond? This is also a heavily shorted stock and is actually one that I own. And I just see, once it came out with its earnings, strong earnings, you can see that this stock has just been, for the most part, straight up. Volume picked up again on Wednesday as we made this breakout. Bed Bath & Beyond, I think, looks really strong here. Overbought, but that sometimes doesn't matter when you've got a short squeeze in play. Worst performer here is Atomera, ATOM. Kind of an interesting chart. And I say interesting because it was showing great AD, accumulation distribution. It was showing really strong relative strength. And then as it's gone through this period of consolidation, you can see the AD line dropped. You can see relative strength has dropped. I really want to hold this double bottom here at $9. So it is in a nice area of the market. Semiconductors are breaking out. Maybe we're just consolidating and we'll catch fire here. Volume has been drying up in the stock, but I do want to hold $9. I do not want to see a close below $9. All right, let's move on. Earnings spotlight. I want to go through a few earnings reports with you. UAL reported after the bell on Wednesday. They came up short on both revenues and earnings per share. The stock was up, but up less than 1%. Just going nowhere here. I think the market is waiting to see what is going to happen with the virus, what's going to happen with these airlines. Are they going to bounce back? I just think there's too much uncertainty. I have no interest in these stocks right now. Alcoa came out after the bell, beat on the top line, beat on the bottom line, still reported a big loss though. $1.17 loss. Market was expecting a $1.51. So it was better than expected, but a loss is a loss. Stock down almost 5% after hours. AD line weak. You look at the relative strength weak. I'm just not a fan. I like leading stocks and leading industry groups, and Alcoa is not really either. PacWest Bancorp. Again, banks had a horrible day on Wednesday. They've just been very weak throughout the pandemic. I'm not a big fan of these banks, even some of them that are showing strength. And I mean, this one is not on a relative basis, but you've got some stocks, some banks like FRC and also Ally, ALLY. Those are both relative winners in banks. So if I was going to be looking at banks, those are two I would consider. Not PACW. They did have a mixed report, though. Actually, no, they did beat on both top and bottom line today. So overall, not bad. It was up about 0.25% after hours. ACCD. This is Accolade, fairly new IPO. Did break out heading into earnings. They had a slight miss, though, 41-cent loss versus 40-cent loss expected. Stock was down 5.6% after hours. I think you got to be careful there. And then the best one of the night in terms of earnings and the reaction was Sleep Number. Big beat on the top line, huge beat on the bottom line, $1.79 versus $1.01. And the stock's up 9.5% after hours with an easy beat and breakout to new highs. So I think Sleep Number looks pretty good. All right. As far as earnings on Thursday, one I would keep an eye on Thursday morning is Taiwan Semiconductor, TSM. We've gotten a breakout. Semis are strong. I really like this stock. I think this is going to be a big report. You may already know that by the time you hear this recording, but I'm looking for a big report on Thursday from TSM. All right, the three you must see, and I'm going to go right into it. First one I want to pull up is DraftKings, DKNG. I mentioned a while back that when it came out with the secondary offering, be careful. I thought it was going into the 40s. It's in the 40s. I actually think the stock looks pretty good as it gets closer to $45. So DraftKings is starting to look much more interesting to me now. TDG, it's in the aerospace area. And even though it's not been a very good performer, wait and see when aerospace wakes up, and it hasn't been a very good performer, but when it wakes up, I look for TDG to lead. And the last one I wanted to mention is TSCO, Tractor Supply. This has been a great performer. Notice relative strength's been weak last 7 weeks or so. That's right when we started consolidating. I think we now have a cup in play. Maybe we get a pullback for a handle, but I think this stock goes higher, and I believe relative strength is going to increase again. All right, that's it for me. I appreciate you tuning in. Have a great day trading today, and I'll be back next week with Trading Places Live. Have a great weekend, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.